The New York Stock Exchange is closed for the weekend, and the last reported price for Rocket Companies, Inc., RKT, on Friday, November 1, 2025, at the 4 p.m. Eastern Time close was $16.66, marking a solid gain of plus 4.71% or plus $0.75 from its open on that trading day. Now, most people looking at that closing jump, particularly after a volatile month for the stock, will chalk it up to a typical end-of-week bounce or maybe a general market lift. That's the surface expectation. But the deeper reality, the one that smart, engaged investors need to pay attention to, is that the late-week rally was fueled by a subtle yet significant pivot in the post-earnings narrative that the street is largely missing. While the immediate chatter focused on the third quarter's adjusted revenue of $1.78 billion, surpassing consensus estimates, and the adjusted EPS beat of $0.07 versus the $0.03 forecast, creating the expected earnings beat headline, the true undercurrent is the guidance. Management projecting fourth quarter adjusted revenue between $2.1 and $2.3 billion, a forecast that incorporates the full integration of both the recent Redfin and Mr. Cooper acquisitions, is the real takeaway. This forward-looking confidence, especially when the midpoint is well above the analyst consensus, suggests a stronger-than-expected belief in the immediate synergistic value of the newly expanded digital platform. This isn't just a win for the quarter just passed, it's a confident, concrete signal for the next one, providing a powerful counterpoint to the prevailing market skepticism about the overall housing and mortgage environment. The stock's ability to pull back from its 52-week high of $22.56 only to stabilize and then jump on forward-looking guidance is a classic tension between a tough current reality for the sector and an executive team's strong future expectation for their specific business. The macro environment, the coiled spring narrative. The common ground assumption surrounding Rocket Companies stock has been straightforward, if a bit harsh. It is a highly cyclical mortgage originator whose fortunes are inextricably linked to interest rates. When the Federal Reserve is actively raising rates to combat inflation or simply holding them steady at a restrictive level, it constricts both refinancing volume, the company's bread and butter, and the overall purchase market due to affordability crises. This macro pressure is the elephant in the room that has kept RKT's stock price compressed for a long time. Investors generally view it as a coiled spring, but one that can't be released until the macro environment, specifically market interest, shifts decisively in its favor. This expectation makes every day-to-day swing a reflection of shifting sentiment on the Fed's next move or the latest inflation report. Trading volume, which was high on Friday at over 80 million shares compared to a recent average in the 50 million range, directly reflects this heightened speculative interest and volatility. Now, the contrarian, deeper take that the market is struggling to properly value is Rocket's deliberate and now integrated transformation into a broader financial technology ecosystem. It's not just a pure-play mortgage lender anymore. The acquisitions, particularly Mr. Cooper, America's largest mortgage servicer, and the previous move on Redfin, fundamentally shift the business model. Mortgage origination is the high-volume, high-margin business in a good rate environment, but loan servicing provides a stable, counter-cyclical revenue stream. When rates are high and originations are down, the value of the mortgage servicing rights, or MSRs, Rocket holds actually increases because people are less likely to refinance their lower-rate loans. This provides a natural, if not perfectly correlated, hedge. The recent Q3 report actually showed a $479.6 million decline in the value of MSRs on the books, which contributed to a GAAP loss of $124 million. However, the company's preferred adjusted net income of $158 million strips out these non-cash mark-to-market fluctuations. This disconnect between GAAP loss, which is reality on paper, and the adjusted profit, which reflects core operational health, is a key point of confusion that sophisticated investors must look past. The reality is that the new combined entity has a vastly expanded client base for cross-selling, not just mortgages, but other products like Rocket Money, Rocket Homes, and Rocket Loans. This is a critical factor distinguishing Rocket Company's stock from its peers. Market dynamics and institutional stance. Looking closer at the recent stock movement, the past month saw RKT drop by about 15% before this recent surge, largely driven by the broader market's renewed fears about persistently high interest rates and the overall pressure on financial technology stocks. The sector momentum for FinTech and housing-related equities has been choppy. When the 10-year Treasury yield spikes, mortgage stocks like RKT usually get hit hard, even if they have a tech angle. Institutional activity has reflected this uncertainty, with a general hold consensus from the 45 analysts covering the stock. Major players are sitting on the sidelines waiting for the macroeconomic clouds to part, which explains the high institutional ownership, around 94.42%, but the relative lack of aggressive buying or selling until the earnings guidance provided a reason to act. The stock's beta of 2.24 suggests it is highly volatile compared to the overall market, making it a favorite for active traders who operate on platforms like Interactive Brokers Trading and Robinhood Stock Trading, but a trickier proposition for passive asset allocators using tools like Schwab Intelligent Portfolios or looking at Fidelity mutual funds. This high volatility profile is a direct result of the market trying to constantly reprice a cyclical business that is in the middle of a structural shift. The core business and competitive advantage. The core business model of Rocket Companies, Inc. centers on being a tech-driven platform for homeownership and personal finance. Their flagship, Rocket Mortgage, is the largest mortgage originator in the U.S. What differentiates them is their massive investment in automation and the digital client experience. They use their in-house proprietary technology to streamline the origination process, often allowing clients to secure a loan 2.5 times faster than the industry average, which is a massive competitive advantage. Other key subsidiaries like Rocket Homes and Rocket Loans diversify their revenue streams. Rocket Homes connects buyers and sellers with vetted real estate agents, and Rocket Loans offers personal installment loans. This move toward a complete ecosystem of home-related services, from finding a house to securing the financing and managing other aspects of personal finance through Rocket Money, is a strategy aimed at maximizing customer lifetime value. They are essentially using their massive scale in mortgage lending as a customer acquisition tool to cross-sell into an entire financial relationship. Older reports confirmed their dominance in the mortgage space, frequently being ranked highly for customer satisfaction, a crucial intangible asset in a commoditized industry. Forward outlook and key scenarios. The forward outlook for Rocket Companies stock is directly tied to the expectation versus reality principle we discussed. The expectation is that mortgage rates must drop significantly for RKT to succeed. The reality, however, is that while lower rates are a massive tailwind, the company is positioning itself to be successful even in a higher-than-longer environment through MSR servicing and cross-selling. Possible scenarios for the stock include a soft landing for the economy, leading to modest rate cuts. This would be the ideal catalyst, boosting origination volumes without compromising MSR values too severely, and could easily push the stock back towards the $22.56 52-week high, a strong return for anyone who bought at the recent lows near $10.06. A riskier scenario is a prolonged period of high inflation leading to further tightening, which would pressure new loan volume and likely lead to a sustained dip. But the Mr. Cooper acquisition mitigates the downside risk here more than ever before. Opportunities lie squarely in the effective integration of their new assets and the successful implementation of their new CEO's AI-focused strategy, which is designed to cut costs and increase efficiency in a market where every basis point of margin counts. The use of AI tools like Rocket Logic, which simplifies the mortgage application, suggests an aggressive internal push for efficiency that will eventually show up in the financials. For the long-term investors utilizing online investment tools and platforms like SoFi Invest or Fidelity Brokerage, the key is to determine if the market is correctly pricing in the stability of the MSR business and the potential of the cross-sell ecosystem, or if it is still mistakenly valuing RKT as just a pure-play, rate-sensitive originator. The strong Q4 guidance incorporating the new business units argues strongly for the latter interpretation. The narrative has shifted from wait for the Fed to look at the platform. We've covered a lot of ground on the business, the stock, and the market pressures. Comment below how many shares of rocket companies you currently hold or what your target price for the stock is if you're waiting on the sidelines. Your insight adds to the collective intelligence. In wrapping up this analysis, the central takeaway remains the significant gap between market expectation and the evolving corporate reality. The general investor expectation is